Minasan, konnichiwa, Zamra Engineer Des. In this lesson, number 3 of chapter 13, we will analyze a company's performance using ratio analysis. So this is the third analysis method that we are going to use. So the first two are horizontal and the second one is the vertical analysis. So let us continue. Earnings per share. It measures the net income earned on each share of common stock. Evaluate its relative earnings performance from the perspective of a stockholder. So earnings per share, very important from the point of view of shareholders. Comparisons of earnings per share across companies is not meaningful. So they have different, but still they are using this. Still they are using this to compare companies to compare. This is not meaningful because they have different areas of concern. They have different line of businesses. They are very unrelated. So you can compare companies to companies in the same market. Same market segment. They have the same target market. So you can really compare two companies going hand in hand. What are the companies that could be compared? For example, Adidas and Nike. Nike and Adidas, the same market segment. Another one is Coca-Cola and Pepsi-Cola. They are on the same segment. So you can really compare their business earnings per share or performance. Okay? Reflects investors' assessment of the company's future earnings with regards price earnings ratio. What is the price? What is earnings? Then take the ratio. If you can compare the formula earnings per share, net income minus preferred dividends. Preferred dividends. So this is only about what? Net income from common stock. Okay? From common stock. Okay? Not preferred dividends. Divide by weighted average common shares outstanding. Okay. Now, price earning ratio, PE ratio, is market price per share divided by earnings per share. What is your company's earnings per share? Calculated on the previous slide. Then, what is the market price per share? So that is price earnings ratio. So it will be higher if investors think that earnings will increase substantially in the future. A futuristic view. It will be lower when there is a belief that the company has poor quality earnings. So quality of earnings is very important. Quality of earnings, not the amount, not just the amount, the quality. Because quality means futuristic view. Amount is just in this specific accounting period. You are better in this specific accounting period, but in the long run, they are seeing that it will change the trend. Example, price earning ratio, market price per share, divided by earnings per share for these different companies. We have here a listing of 5 popular companies: Southwest Airlines, Google, Apple, Skechers, and Nike. They have the following. So they calculated earnings per share and they calculated price earnings ratio. So we are looking at the ratio right now because we cannot actually compare the earnings per share. You can compare the price earning ratio 19, 25, 27. So which one is the best here? Skechers. Okay, so there is a future for this investment. Okay. Liquidity ratio. Working capital is equal to current asset minus current liabilities. We already know that. from our previous lectures. Current ratio, current assets divided by current liabilities. Similarly, we already know about this. Inventory turnover, cost of goods sold divided by average inventory. Inventory turnover. Days in inventory, 365 days divided by inventory turnover. So far, we already discussed about this in our previous lesson. And number 5, we have accounts receivable turnover. Net credit sales, then average net accounts receivable. And average collection period, 365 days divided by accounts receivable turnover. So those are for what? Liquidity ratios. Now, investor insights. Let us tackle this. The apparent simplicity of the current ratio can have real-world limitation because adding equal amounts to both the numerator and the denominator causes the ratio to decrease. Okay? Assume, for example, that the company has 2 million of current assets and 1 million of current liabilities. Its current ratio is 2. If it purchases 1 million of inventory on account, it will have 3 million of current assets and 2 million of current liabilities. Its current ratio decreases to 1.5. So from 2 to 1.5. If instead the company pays off 500,000 for its current liabilities, it will have 1.5 million of current assets and 500 current liabilities. Its current ratio increases to 3. Thus, any trend analysis should be done with care because the ratio is susceptible to quick changes and is easily influenced by management. What are they doing? They are not doing the normal operation. They are what? Consciously manipulating the numbers. That is the wrong thing to do. That is actually the unethical thing to do. If that the data is coming out from normal operation, uh, previous tradition of the company, no what no manipulation and control by the management of the numbers. But that is impossible to do because always management wants to look impressive from the eyes of the to the eyes of the public. They want to be impressive, and they are impressive. Their stock prices will go up. So they will really do this. So solvency ratio is a third set of ratio. Debt to assets ratio. Total liabilities divided by total assets. Times interest earned. Net income plus interest expense plus income tax expense divided by interest expense. We already know all these things. Free cash flow, we already know all these things. So, we already know all this formula. Now we have what? Profitability ratios. Earnings per share, price earnings ratio, gross profit rate, meaning gross profit divided by net sales, profit margin. Okay, this is the first time we have this. Profit margin is net income divided by net sales. That is our profit margin. Okay, net income divided by net sales. And gross profit rate, gross profit divided by net sales. Return on assets, net income divided by average total assets. Assets turnover, net sales divided by average total assets. Payout ratio, cash dividends declared on common stock divided by net income. Return on common stockholders' equity. So there are only one or two items here that we just discussed at first instance. All the others we already discussed on our different lessons before. Okay, we have another investor insight. High ratings can bring low returns. Moody's, Standards and Poor's, and Fitch are three big firms that perform financial analysis. These are very reliable, some reliability out of each of these. Their pronouncement, their analysis are taken as law by the market. Okay? And even governments look for their data, information, and analysis. So on publicly traded companies and then published ratings of companies, credit worthiness. They also rate governments. They also rate countries. Okay? Investors and lenders rely heavily on these ratings in making investment and lending decisions. Some people feel that the collapse of financial market was worsened by inadequate research, reports, and ratings provided by financial rating agencies. There are so what long period of, for example, Enron and the Madoff, the Bernard Madoff case. The analysis given by this are positive, and they are positive year after year and after year, thus making the ratings good every year for several years. Then later on, somebody found out that they are not the real score. So what happened? Damaged the economy and the businesses of several companies and countries and people. And critics contend that the rating agencies were reluctant to give large companies low ratings because they feared that by offending them, they would lose out on business opportunities. For example, the rating agencies gave many so-called mortgage-backed securities ratings that suggested that they were low risk. Later, many of these very securities become completely worthless. Steps have been taken to reduce the conflicts of interest that lead to these faulty ratings. They have business interest. They have business interest of their own, so there is a conflict of interest that happens. So that's why this economic economic burst happened in the past. These are real incident that happened. So again, this is Dr. Rippy, preaching engineering for nation building.